Hey everybody, Mitch Wilder here. Welcome to the Ahead of the Curve podcast. Really excited to be back here with Micah Frame. Micah, how you doing today?
Good. How you doing, buddy?
Good. Well, we're talking about something today that we've taken something kind of complicated and we've worked really, really hard at making it simple. So we took like 20 minutes to make it more simple.
So much time. Painstaking.
It was rough. It was rough. Well. Anyway, this is what we're going to be talking about. So I'll kind of share it from my vantage point. You know, as a business owner, if we have an S-Corp, when we have that meeting with our accountant or our CPA, and they're trying to explain to us what it is that we're taxed on, that can be a little bit of a confusing conversation. You know, if we're like, you know, I only took $50,000 of income out of the company, why am I being taxed on $150,000? That can be a confusing conversation. We found, and personally I've found, that the CPAs, the accountants that I've worked with in the past have struggled to communicate how this works. So we're going to go through a diagram. We've simplified the process to show you really how taxable income flows through an S-Corp. Mike, am I describing all of this correctly?
Yeah.
Okay.
Perfectly. And again, this is a discussion we have every year with a fair number of clients, just because it's not intuitive and it's not the way you would naturally think about profitability and the taxability of income.
Very true. And that's the thing, is it's just different. And I think it's outside of what people expect. So would you like to start? Should I share the diagram and we can start there?
Yeah, absolutely.
Okay,
Yeah.
perfect. And I'll let you explain and I'll jump in with questions. So let me share here.
All right, so what we're looking on this chart is there's a few different flow charts that we have, but the main one, or the one we'd start with, is this one on the left. And just kind of to make this a little more real world, run through a hypothetical scenario on S-Corp income. So in this one, top box, we've got your business's revenue. We're saying that's $1 million. That you've got operating expenses of $850,000, and then you, as the owner, paid yourself via W-2 a $50,000 salary. And that's going to show a bottom line profit for the S-Corp of $100,000.
So we have the example of W-2 compensation. So this is W-2 compensation would be the owner was basically taking a paycheck out of the company. They have a weekly or biweekly paycheck that they're taking from their company that they own, and their taxes and all those things are being deducted out of that check, correct?
Yes, and run through an actual payroll processor to where you're going to have your W-2 at the end of the year, 941s. You've got these ongoing payments, not sort of the colloquial way we would describe a salary as just, okay, this is what I transferred from my business bank account to my personal. So this is being run through true bona fide payroll.
Okay, so something like Gusto, somebody's running it through Gusto.
Yeah,
It's
exactly.
being processed. Okay. Now the other side of that coin, which we don't have pictured here, would be the scenario that you brought up, where somebody is transferring the money, or moving it from the corporate bank account to a personal bank account.
Yeah, absolutely. And that's where a lot of the confusion will come into play, is that people will have the discussion of like, okay, well, your S-Corp made $200,000 this year. And so that's what you're being taxed on. People say, no. I only took $60,000 out of the company. I only took $60,000. That's the only income I have. It's not $200,000. I only made $60,000. And what we're getting into now, and what we'll show on some of the other charts, is that that's just not the way that the IRS looks at it. The IRS is taxing you based on the profitability of the business irrespective of if you drew all the money out of it or kept every bit of it in. So in this scenario that we're talking about, where this person is 100% owner of this S corp, what they're getting taxed on is that $100,000 net profit that they will receive by a K1, and then the $50,000 in their W2. So they're getting hit with $150,000 of taxable income. Doesn't matter how much of that profit they chose to distribute from the S corp and how much they chose to retain in there.
Okay, so just to be, so when you're having the conversation with your accountant or your CPA, and they keep saying it's a flow through, right? It's a flow through organization. That's what they're meaning is the profit, this net profit here that we're talking about right here. It doesn't matter if that stayed in the company bank account. That profit is flowing through to you.
Right, exactly. All that income or loss is flowing through to you individually, and that's where the taxes are being paid. If you compare that to a major, like a Fortune 500 publicly traded company, in those setups, and those are taxed as C corporations. In those setups, the corporation pays tax on whatever the profitability is, and then when you distribute it, then that's a totally separate taxable event. That's what they talk about, the double taxation. So I think that's part of the confusion, is that for big companies, if you receive dividends, that in and of itself is a totally separate taxable event, and that triggers additional taxable income.
Got it. That makes a lot of sense, and I think it makes it a lot more clear. So while we're on this topic, right, we just have the W-2 compensation of 50,000 as an example. A lot of people who own S corps are not taking their income that way, right? I would probably, and tell me if I'm wrong here, I'd probably say that the majority are simply, you know, probably not frequently running payroll for themselves, maybe a little bit, but I'd say the majority are probably doing that, distribution type transfer from their business account, the S corp, to their personal account. Is that accurate?
Yeah, absolutely. And for compliance with an S corp, you're required to run a W2 for yourself with a reasonable salary.
Right.
And there's different things of what the sweet spot would be for that, and just for your qualified business income deduction. But in both cases, normally people, that's not the money you're living off of. A lot of times people will have their withholding jacked up really high, or their retirement plan distributions, and that's being funded from the salary they have. So for me, I do not take, and I haven't for years taken an actual net check on my W2, because all that's going to income tax withholding, retirement, and retirement. So that's not what I live off of. That's a mechanism to make payments to the government mostly. But what I'm actually living off of, exactly what you're talking about, is owner's distribution. So that's the way people are paying, if not the majority, a large portion of the compensation that they're taking out of the company to fund living expenses. Most of that's through owner's draws.
Okay, so I've got a question about this. I think that it's the question that is is probably lingering on a lot of our viewers' minds about this from their experience with their S corp. Um, the term that I've my previous CPA that I heard my previous CPA use was, I remember being in a situation like this, and they're like, okay, well, this was your income, and it's like, well, no, it wasn't, and well, that's what you're going to be taxed on. Well, where is that money at? Well, that was an accounting profit. That was the
Yeah.
conversation I had. Um,
Yeah.
so how does one, since whatever is showing right as the net profit, if my understanding of this is correct, whatever's showing as the net profit is going to go into what you're going to be taxed on. We're going to talk about that in a minute. How do you make sure that you account for this and make sure that you have enough for that? What are some strategies that you find that people should employ?
So the main one is going to be keeping up with your books on an ongoing basis, so you know what that book or tax profit is. because exactly what you said, it's not synonymous with cash flow. It's not synonymous with it in terms of how much you distributed out of the profits or even what that bottom line profit is. And it's really getting into it is a whole nother discussion, but
Sure.
you just think about loan payments and debt payments. You can have a ton, let's say you've got a mortgage or you've got a business loan, you can have a huge amount of cash flow that's just going out of your company, but those loan payments aren't business deductions. It's a reduction, or they're not expenses. It's a reduction in loan principal. So that's one of the reasons why just keeping a tight grip on what your profit is for tax purposes is just going to make it, and by doing that with having your books up to date, is going to make it so much easier to know what that number is, and thereby what the tax liability is going to be, whether or not you need to create some additional, like spend more money that year to accelerate expenses. It's super basic, but just having your books done and paying attention to those numbers is a huge portion of the battle.
Okay. Is there anything that an owner can do? Now, one thing that I have done, I don't know if this is a good strategy or not. Um, I set up a separate account within my corporation, separate checking account actually, that I would transfer those profits into the net profits into, and then I would hide it so
Yeah.
that as much of that cash was there as possible, at the end of each month, so that basically what I was trying to do, because of being into the situation, several times, is have access to it, but kind of make it almost like a check valve, like a one-way street, where
Right.
it was a little bit easier to put in there than to take out, because a lot of us admittedly do, bank account, checks to make financial
Right.
decisions,
Right.
so
Yeah. I
that way it
mean
was
that.
like, it's not there for me to be like, oh, we've got the money, let's spend it. It was just kind of out of sight, out of mind. But in the case of an emergency, we had access to it. Or like you said, if we needed to accelerate some expenses for the year, for the most part, I tried to keep the amount that was in that account and what was going to be showing on my net profit as close to each other as possible.
Yeah, having that sequestered, and with that method or other whatever works from a behavioral standpoint is a pretty smart move, just because, like you said, we make a lot of our decisions based on how much is in the bank.
What's the
And
balance?
if that's our metric and we're not paying attention to our books and other reports we have, that can be pretty deceptive, and then depending on your situation can get you in trouble.
Yeah. Yeah. Now, before we move on to a little bit deeper into this, uh, with there's one thing that I want to address. I've heard so many business owners say this about an S corp. They're kind of the mindset that they want to get rid of as much of that money as possible so that they're not taxed on it. Now, I don't and I want to hear your opinion on this. You're the one that knows, but I'm just not of the opinion that, hey, if I've got $100,000, I'm going to spend $100,000 to avoid, paying 24,000, or
Right.
30,000,
And well,
depending on
I
your
mean,
tax bracket. Just doesn't make
there's a
sense to
couple.
me.
Right. And there's a couple different fallacies and issues there. One is that, again, just to reiterate, distributions are not expenses. So just by sometimes people want to distribute it to themselves personally, and that's fine if you want to do that for liability or cash flow. If you want to do that, that's fine, but it's not an expense. It's not a deduction just by moving it out of the business and to yourself personally. But also, even if you're in the top tax bracket, when you factor in if you're in California or New York or a higher income state, the top tax bracket is 37% right now. And then you've got the state taxes. So call it 50 cents on the dollar just to be generous. If you if you're spending money purely to reduce your taxable income and thereby your tax bill, that's not it's just not a great move, because
Not a
if you're
great
spending the
financial
money
move.
right, if you're spending the money strategically on things you already need to do, and you're looking at the ebbs and flows of your profitability, spending money intelligently is a big part of tax planning. But just spending it with no real planning or regard, or looking at what the return you're getting on that spending is, spending just to spend, does very, very little for you.
So let's look at one example just before we move on. So one example is, we know that we're going to need to get a new vehicle next year for the business. We know that it's going to come early the next year. We now it makes sense to accelerate that purchase and get it now, because we know we're going to have to get one, as opposed to, I need to spend this money to reduce taxes, so I'm going to buy a new vehicle because I want one. It seems
Right.
nuanced, but is that the right way to look at that?
Yeah, absolutely. First thing, you want to look at the business's cash flow, so because you need to take care of the business for the business to
Of
take
course.
care of you. So first, you'd be looking at the cash flow of the business, what your sort of burn rate is, if you're looking at reinvestment, all of that stuff. Then, assuming the business is large, is taken care of, then you can distribute to yourself. And that might be the best move, again, depending on if you're wanting to invest that money personally or different things. What I will tell people that they can be need to be a little careful of, just behaviorally, is sometimes once it makes it into the personal account, people will have a little less be a little less judicious with their with how they spend it. Once it makes it into the personal account, sometimes that's okay, that's my money, that's found money, so I'm going to just burn it on everything. You're welcome to distribute it, welcome not to. And again, that really depends on your planning and what you have going on in your own financial situations. But in either case, leaving it in there, taking it out, the same idea of sort of sequestering that money and making sure that you're using it smartly, and that you're not just spending it just for the sake of spending it. That's the only thing that I'll say, is that sometimes once it makes it into the personal account, people get a little less careful on how they're
Sure.
spending it.
Sure. Well, and that makes a ton of sense. I mean, you got to make sure the business is taken care of. You have been taxed on that, and this is where you need to make sure that, among other things, you're using the right corporate structure for your business, how much you're making, your personal and professional financial goals. So that makes a lot of sense. I'm sure we could talk even deeper on that topic, but again,
Yeah.
we want to keep this
Yeah.
simple. So let's move into just this other part, of some phrases that you're going to hear your CPA talk about. So, looking at this, we've got the C Corp with $100,000 profit. Okay, let's pretend in this example that you are 100% owner of the S Corp. Explain a little bit about how this process works that we're looking at, because if you own an S Corp, you've heard these phrases, you probably weren't 100% sure how they work together.
So this S Corp made $100,000 profit, same as what we showed on the last slide.
Right here.
So your S Corp is going to file its own tax return. It's called an 1120S, which is just the S Corp's income tax. Then the S Corp is not going to pay any federal income tax on its own. All of that is then going to flow through to you individually. So the mechanism by which that is done is that the 1120S, the S Corp return, generates a form K1, which is your percentage of whatever that profit and loss is, and that's based on your ownership percentage. So in this scenario, the S Corp made $100,000 profit. All of that flows through to you individually from the K1. The K1, you'll input that on your individual income tax return, and that's where the income shows up and where you pay tax on that income.
Okay, perfect. I that's such a good description, because we hear all those tax forms, and from a business owner entrepreneur standpoint, you're like, okay, what do those forms do again?
Right.
And so I love the description. It makes it all very clear to help us see what forms are involved, how it flows from the corporation to you, right?
Yeah.
And then the next situation is when an S corp has multiple owners, correct? Okay,
Exactly.
so let's look at this one. So this is an S corp that has multiple owners. Now, does this also apply if it's an LLC taxed like an S corp?
Yes,
Okay,
absolutely.
all right, perfect. So
Yeah, S corp is a tax election, so that's
election,
going to
right?
be true whether it's a corporation or an LLC, either one of which could elect to be taxed as an S corp.
Perfect. Okay, thank you. And so explain to us the example here and how it's different, let's say, with two owners that don't, you always see 50-50, two owners that don't have equal share of the S corp.
Right. So this is the same profit scenario that we've been dealing with. This one's $100,000 profit again, but you've got a 60-40 split between you and another owner. So that $100,000, you're it's taxable income, but we're just splitting that into two separate K1s. One of which for you, which will show $60,000 of income. You put that on your individual income tax return. And then your partner, the remaining $40,000, his 40%, that's going to go on his individual income tax return.
Got it. Super simple, really clear.
Mm-hmm.
Love the explanation. Hopefully for anybody who's experienced this where every year that they talk to their CPA or their accountant and they go over this and it's confusing, my hope is that this comes to mind and this they can think of this chart and see this chart and it all becomes really clear. And what we'll do is we'll put this video along with access to this chart in the ahead of the curve community, which is just kind of where we we put things for our viewers and for people who want to go back and remember how this works. We'll put the link to that down below, and we'll put this video with the description of how this works in the community, so that people who want to revisit this before they do their taxes make sure that they're on the same page, have that. So Micah, is there anything else within this process that we've discussed that we need to be aware of or that we want to make sure is covered? Or do we now have a good understanding of how this flow through works?
I think that's for the purposes of what we're trying to illustrate here. I think this nicely illustrates it and doesn't get too in the weeds on other things. But kind of what we've talked about is like looking at this one on the little box on the far left, it's understanding what your taxable profit of the company is, how much you're taking as W-2 salary, and then what your percentage of the company's profit is. If you're a 100% owner, that's really easy. If you've got other partners, just being aware of that. But that's sort of the mechanisms by which this income will flow through and pass through to you individually, and what will create the most direct income tax ramifications.
Perfect. Well, I'm going to stop sharing this now. Again, we'll put all the resources here below the video so you can get access to this within the Ahead of the Curve community. Excuse me. And Mike, I really appreciate the breakdown because I know that's a really frustrating conversation to have. I remember, before you explained it to me, I could not find an accountant or a CPA who could easily explain to me how that works. Even though it once you see it, it's like, oh, it's actually pretty simple. It's just not as simple. People really struggle to explain it. So thank you for doing that for us today. Appreciate it. And we look forward to connecting with you on a upcoming future episode.
Oh, you want me to talk? Sorry.
I always want you
Thanks,
to
man.
talk.
Thanks, man. Appreciate it.
You're smarter than I am. I always want you to talk. So
It's not true.